Capital gains tax is a crucial part of India's direct tax system. It's basically a tax you pay on the profit you make from selling a valuable item. This profit is called a capital gain. So just think of it like this. You buy something for a certain price, and later you sell it for a higher price. The government taxes a portion of the profit you've earned from this transaction. And this tax actually applies to a wide range of assets, not just stocks or property. Understanding this concept is the first step towards managing your finances effectively, and of course, complying with the country's tax laws. It ensures that wealth generated from asset appreciation contributes to the nation's development. So what exactly is a capital asset? According to the Income Tax Act, a capital asset is any kind of property held by a person. This can be for personal use or for investment purposes. The definition is quite broad and covers many things. Obvious examples include land, buildings, houses, and apartments. It also includes vehicles, patents, trademarks, and leasehold rights. Even jewelry, archaeological collections, drawings, paintings, and sculptures are considered capital assets. Essentially, almost any item of value that you own can be classified as a capital asset under the law, and its sale could potentially attract tax on the profits generated. It is important to note, however, that not everything you own is a capital asset for tax purposes. The law specifically excludes certain items. For instance, any stock in trade, consumable stores, or raw materials held for your business or profession are not capital assets. Their sale is treated as business income. Similarly, personal effects meant for day-to-day use, like wearing apparel and furniture, are generally excluded. There's a special mention for agricultural land in rural India, which is also not considered a capital asset. Understanding these distinctions is vital to correctly identify which of your sales transactions might be subject to capital gains tax. The primary purpose of this tax is to generate revenue from the profits earned on capital investments. When the value of an asset increases over time, the owner gains wealth. The government sees this gain as a form of income. Therefore, it is taxed, just like a salary or business profit would be. This principle helps in creating a more equitable tax structure, where wealth accumulation through investment is also taxed. It plays a significant role in funding public services and infrastructure projects across the country. For every citizen, being aware of this tax is not just about compliance, but also about understanding how wealth creation is linked to national progress. The Indian tax system divides capital gains into two main categories. These are short-term capital gains, or STCG, and long-term capital gains, known as LTCG. The distinction between them is based entirely on the holding period. The holding period is simply the length of time you own the asset before you sell it. This duration is critical because it determines how your profit will be taxed. The government has set different holding periods for different types of assets. This policy encourages long-term investment over short-term speculation. Knowing the correct holding period for your specific asset is the key to understanding your potential tax liability and planning your investments wisely. For most capital assets, the timeline is quite straightforward. If you sell an asset within 36 months or 3 years of acquiring it, the profit is considered a short-term capital gain. However, there are some important exceptions to this rule. For immovable properties like land, buildings, or a house, the holding period for it to be considered long-term was reduced to 24 months or 2 years. This change was made to provide some relief to the real estate sector. Therefore, if you sell your house after holding it for more than 2 years, the gain will be classified as a long-term capital gain, benefiting from a different tax treatment. The rules are different again for financial assets like equity shares listed on a stock exchange or units of equity-oriented mutual funds. For these specific assets, the holding period is much shorter. If you sell them after holding them for more than 12 months or 1 year, the profit is treated as a long-term capital gain. If you sell them within 12 months, it is a short-term capital gain. This special shorter holding period is designed to boost activity and investment in the capital markets. For other assets like debt mutual funds or gold, the original 36-month rule generally applies for them to qualify for long-term status. Understanding this difference is not just an academic exercise, it has very real financial consequences. The tax rates for short-term and long-term gains are significantly different. Long-term capital gains are usually taxed at a lower preferential rate. This is a deliberate policy to encourage investors to hold on to their assets for longer periods. It promotes stability in the markets and fosters a culture of long-term wealth creation. In contrast, short-term gains are taxed at higher rates, often at the same rate as your regular income. This discourages quick buying and selling for speculative profits and ensures a fair contribution to the tax pool. Calculating capital gains tax might seem complex, but it actually follows a logical formula. Let's start with a simple example for a short-term capital gain, or STCG. Imagine you bought 100 shares of a company at 200 rupees per share in January 2025, costing you 20,000 rupees. You then sold all these shares in October 2025 at 250 rupees per share, receiving 25,000 rupees. Since you held the shares for less than 12 months, the profit is an STCG. Your gain is the selling price minus the cost of acquisition. 25,000 minus 20,000 equals 5,000 rupees. For listed equity shares, STCG is taxed at a flat rate of 15%. So your tax would be 15% of 5,000, which is 750 rupees. Now let's look at a long-term capital gain, or LTCG, example involving property. Suppose you bought a flat in May 2021 for 40 lakh rupees. You sold it in June 2025 for 60 lakh rupees. Since you held it for more than 24 months, it's an LTCG. Here we introduce a concept called indexation. Indexation allows you to adjust the purchase price for inflation, which increases your cost base and reduces your taxable profit. The government releases a cost inflation index, or CII, each year. Let's say the CII was 317 in 2021 to 22 and is 380 in 2025 to 26. Your indexed cost would be 40 lakh times 380 divided by 317, which comes to 47.95 lakh rupees. With the indexed cost calculated, we can now determine the taxable long-term capital gain. Your selling price was 60 lakh rupees. Your indexed cost of acquisition is 47.95 lakh. Therefore, your taxable LTCG is 60 lakh minus 47.95 lakh, which is 12.05 lakh rupees. The tax rate for LTCG from property is generally 20%. So, the tax you would need to pay is 20% of 12.05 lakh, which equals 2.41 lakh rupees. Without indexation, your gain would have been 20 lakh, and the tax would have been much higher. This benefit is a significant advantage of long-term investments, as it protects your gains from being eroded by inflation over the years. For long-term gains from listed equity shares and equity mutual funds, the rules are slightly different again. There is no indexation benefit available for these. However, there is an exemption. Long-term capital gains from these assets up to 1 lakh rupees in a financial year are completely tax-free. Any gain above this 1 lakh limit is taxed at a flat rate of 10%. For instance, if you made a long-term profit of 1.5 lakh from selling shares, the first 1 lakh is exempt. You would only pay tax on the remaining 50,000. Your tax would be 10% of 50,000, which is 5,000 rupees. This tiered system encourages small and retail investors to participate in the stock market. The Indian Income Tax Act provides several legal avenues to save or reduce your capital gains tax liability. These are not loopholes, but are specific provisions designed to encourage reinvestment into certain assets. One of the most popular options for long-term gains from property is Section 54. This section allows you to claim an exemption if you use the capital gain amount to buy or construct another residential house within a specified time frame. If the cost of the new house is equal to or more than the capital gain, your entire gain can become tax-free. This is a powerful tool for individuals who are upgrading or moving homes. Another widely used provision is Section 54 EC. This allows you to claim an exemption on long-term capital gains from any asset, not just property. To do this, you must invest the capital gain amount in specific bonds issued by government entities like the National Highways Authority of India, or NHAI, or the Rural Electrification Corporation, or REC. These are often called capital gains bonds. You must invest within 6 months of selling the asset, and there is a lock-in period of 5 years for these bonds. The maximum investment allowed under this section is 50 lakh rupees in a financial year, providing a substantial tax-saving opportunity for large gains. For gains arising from assets other than a residential house, there is Section 54F. This section is useful if you sell something like shares, gold, or a plot of land and want to invest in a house. Under Section 54F, if you invest the entire net sale consideration, not just the profit, into a new residential house, you can claim a full exemption on your long-term capital gain. If you invest only a portion of the sale proceeds, the exemption is granted proportionately. This provision encourages the channeling of investment profits into the housing sector, which is a key driver of the economy and provides social stability. Finally, while saving tax is a smart financial move, paying the tax that is rightfully due is a fundamental responsibility of every citizen. The taxes you pay, including capital gains tax, directly fund the country's progress. They build roads, schools, and hospitals, and support national defense and social welfare programs. Honest tax compliance is a mark of good citizenship. It ensures a level playing field and contributes to building a stronger, more prosperous India. Therefore, understanding your tax obligations and fulfilling them diligently is not just a legal requirement, but a patriotic duty that benefits everyone in society.